Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through some comments. I'm going to answer some questions and comments and give you my opinion. One of the ones I, I want to answer here is I know how you feel about the investment thesis of Cathie Woods. I'm seeing that in a lot of the exponential technology investment leaders like Cathie Woods, Michael Saylor, and a new one for me is Jeff Booth. These guys really are sticking to the deflation because of technology thesis. So I don't prescribe to the technology thesis. I think it is completely wrong on all accounts. It doesn't even fit the old inflation deflation definition. So what I'm talking about is monetary inflation and deflation. What they're talking about is price. They're talking about prices. Prices do not impact inflation deflation. They may impact what the cost of a product is, but that technically isn't inflation deflation. It is in relationship to CPI and the new numbers that they're trying to rig and manipulate. I agree with that. So it is confusing. The way that I define inflation and inflation is monetary measures. And the reason that is important is because that money goes somewhere. It goes into a bank. It goes into assets that the bank is putting it into, like stocks and bonds. That is inflation. That money goes somewhere. It is in the system. Just because we don't see it in prices doesn't mean that money doesn't exist. So the way that they try to confuse people is they try to turn all of everyone's, we'll call it attention, right at prices, because they can control and manipulate prices. They can't control and manipulate the inflation deflation, which is just more or less the M2 money supply. That's it. So they manipulate inflation through prices. So what they're saying is, oh, well, technology will decrease the price of things. I don't care about that. What I care about is how much money's in the system and where can it flow. If you have a bunch more money into the system, it's going to flow into different assets depending on the interest rate. If the interest rate is increasing under a very high inflationary period, that money is going to rotate into other sectors. It's going to go and flow into commodities and precious metals. So the reason it's very important to know if we're in an inflationary environment is because money's coming into the system. And what you're going to do is if it's inflationary, it's going to impact interest rates. And once those interest rates start to impact bonds and stocks in a negative way, whatever interest rate that is, it's going to start to flow money differently. It's going to rotate into other sectors. They're talking about something completely different than that. They're talking about prices. I don't care about prices. I'm talking about money in the system and how it's going and being diverted. So looking at this, can you talk about the company Zillow in one of your videos? Does it have an effect on the housing market? No, it doesn't have an effect on the housing market. And what I think they did is they put these estimates on there. They have AI. They say, take some pictures. We'll give you an estimate, and then we'll pay for your house. Or we'll do some deal. And I don't even know if they do it sight unseen. Probably the AI, the artificial intelligence in their models was probably messed up. So they were buying homes for far too high of a price and then trying to resell them. And now they're stuck with homes that aren't in good underlying, structural condition. So there's probably people that were ripping Zillow off, literally, where they wouldn't take pictures of something, or maybe they would try to hide something, like maybe a foundational problem, whatever it may be. I don't know if AI would necessarily pick up on that. So I think that they probably just didn't go into that business with the correct mindset. They're probably relying too heavily on AI and software type things versus boots on the ground looking at things. So that's kind of my take on it. No, it's not going to. In order for the housing market, real estate market to be impacted dramatically, we have to see inventory go way up. We are seeing inventory go up. It's not going up enough, though. So we are still in a big, we'll call it bull market in real estate. And it could be seasonal. It's difficult to say. And this stuff takes time for things to turn around. These things don't turn around on a dime and say, oh, we're at a top. It's just going to crash from here. It's like, it doesn't take that. It takes way longer than that. It takes years to turn the housing market around. We're going to see higher prices continue to go up. And then if inventory slowly basically normalize, we'll see the increases become smaller. Then eventually, maybe 2, 3, 4, 5 years down the road, we'll see smaller increases. and then we'll see a turn at some point, but that's probably way off in the distance. We have a very big shortage of homes. 5.5 million is what the latest number is. So we have to see inventories and days on the market creep up and go up in both of those. They are still very, very low. We are in a big bull market in real estate still, and I don't see that changing anytime soon. That's my take on it. Did you take any profit in recent months? I have not. It says, go over the recent massive 30% drop in Forum Energy Metals, possibly due to Uranium Insider selling half position and subscriber following. However, many more drill results coming and more drilling on the horizon. Well, they were drilling Janus Lake. I think that's a nickel deposit. They own more than just uranium. They've got some metals. They've got uranium as well. So if you're looking at it from the uranium perspective, I would be holding it. I'm not afraid. A 30% drop to me is like, whatever. I mean, I'm not afraid of it. I position size all these things correctly. I actually bought more of Forum Energy Metals, and I do my own thing. I don't listen to Uranium Insider. I listen to them, but I don't do anything with that information. I make my own decisions. If uranium's as big as it's going to be, and they've got good properties to drill, why wouldn't I take it? The Janus Lake, and Nova has a royalty on that Janus Lake one, and Rio Tinto. They had, I think that was their first drill result, and they're probably going to come out with more drill results for that property. But I'm riding up, so that's it. It says, I agree on your free ride trade-off, no concern. But as Rick Rule once said, if you're up 300%, you're 300% more exposed. Well, I was up 300% in SM Energy, and now I'm up 2,300%, which is a 24 bagger. Should I have sold? No, it depends on your valuation and how you want to run things. There's a lot of sayings, and I'm not. He obviously knows quite a bit. I'm not saying anything like that, but I'm going to run my own thing, and I'm going to ride it until the valuations look bad, and if I can't find another more enticing investment, I'm not going to sell it. I'm just going to hold on. Now, you guys can do what you want. If you want to put your stuff into free ride, if you want to protect the money that you have, you can do that. What I'm doing is I'm riding it up. When I look at the charts and the charts look good, I'm going to continue to ride it until the charts look bad and the valuations are gone. Until our market conditions until they change. So that's the way I'm playing it. And you can play it any way that you want. If you feel more comfortable putting things into a free ride, which means that you leave your profits ride and you sell and take your base money out, then do that. I would definitely do that if that makes you sleep better at night. It says, Andy, question, playing devil's advocate here. What would you say we would see if the housing market crashes before going up? I understand the housing shortage causing the spike in inflation in the future, but what do you think about what do you think would happen if it crashes before launching up? Well, housing just doesn't crash, guys. It doesn't just come out of nowhere. It's a supply-demand balance. And the housing market doesn't just do this out of nowhere. It's very slow moving. It may take 2 or 3 or 4 years to increase the inventory before it can even crash. It's not like the stock market. It's not based off of the whim. The way that you could crash it, if you were to crash it, is you'd have to stop the economy. You'd have to stop people from building and moving, like we stopped the economy last time. That's the only way you could really crash it. The structural deficit in housing is there. That's why we have such low inventory. We have such low days on the market, and we wouldn't have this like fast crash unless we would see it in the inventory build. We would see it coming before it happened. This stuff doesn't turn on a dime. It doesn't work that fast. It takes years for inventory to basically replenish themselves. So I don't think that the housing market is going to crash quickly. In 2007, so in 2005 and 2006 is when we started basically having a ton of inventory come on the market. And then in 2007, it got even, 2007 and 2008, it got really bad. And inventory was way past 10 months, 11 months, 12 months. In some areas, it was 30 months of inventory. We are at below 1 month of inventory in a lot of different cities. And all over the nation, we're below 3. 3 months, which is incredibly bullish. It's super low. And our days on the market are getting faster and faster, not slower, which means we're turning that inventory even faster. That doesn't scream a housing crash. And I don't prescribe to any of these YouTube people. They're like messed up in the head. They don't know how to look at the markets, apparently. They do not know what they are doing. They are selling bad information to people who think that this housing market's just going to crash and turn on a dime. Sales may go down, but you're selling less homes because you have no inventory to sell. So sales will naturally fall when you have no inventory to sell. You have less inventory to sell, less sales. Now, when you look at these things, make sure you are looking at these things from a year. So if it's September of 2021, compare it to September of 2020, not the month before. Because we have seasonality, and every year we decline in sales because of seasonality. Seasonality, where it kind of peaks around July, August time frame, and it comes back down over the winter. We have less sales over the winter. So what we do to normalize that and how to look at it is we compare it on a year-over-year basis of the same months. And we want to see that continually go up. Now, inventories can go up some. It doesn't mean that we're going to crash. Inventories can come up 20 or 30%, and house prices are still going to be on fire. We still have low inventory. We still have fast days on the market. Our active listing count, which is inventory, is very low. So prices are going to continue to go on up, in my opinion. We don't have the inventory. The inventory has to come first before prices can move. And it's slow moving historically. Looking at, so he's talking about recaf. Yeah, recaf is bouncing. They're going to give results in early December. Yep. I'm still holding all my shares. I'm not doing anything with that. So this guy, he says, silver's getting crushed. Metals and miners are selling off. They are clearly dead money. Banks are in control, shorting. So here's my question. If the banks don't want you in silver, where do you think you should be then? You should be in silver. If the banks are controlling and manipulating gold, silver, and platinum, why do you think they're doing that? If they're not manipulating, let's say, crypto and these other ones, they want you to put your money in those things. They don't want you to put your money in the metals. You know what I'm going to do? Exactly opposite of what they want. And if they're manipulating it, it means that they're creating a valuation which is far too low than what it should naturally be at. At some point, they're going to lose control, and it's going to be revalued far, far higher than where it is today, in my opinion. And if they go to a paperless currency, the only way that you could potentially transact out of the system, which we can today in paper dollars, might be gold, silver, and platinum. And they don't want you to be there because they don't want you to transact outside of the system. Therefore, if that's the last thing that can transact outside of the system is physical precious metals, they may carry the largest premium of anything because they're the last thing that can transact out of the system without them knowing. So there could be a huge premium down the road because of that. So I am of the kind, or of the ilk, that thinks that you should own some physical metals. And that's kind of my take on it. Moving on down. Next. They were talking about people and they can't believe selling uranium. I agree with that. Looking at this, famous hedge fund manager just said that high interest rates resulting from Fed tapering will crash housing market. That problem, workers shortage and material prices could do it. I said, well, since they said it, it must be true. Says, no, I just mean it's interesting take. They are buying lots of mortgage-backed securities, keeping rates low. If they stopped, what would happen? Nothing would happen because we have a housing shortage. The shortage is going to drive the prices. The loans, yes, homes will become less affordable, but I don't think it's going to hurt the housing market as bad as what most people think. So it's not like every single time in history when house prices have gone up, real estate, they've gone up under the conditions of rising interest rates. What it is inflation starts to get larger and larger, more inflation. Interest rates go up and chase that inflation. So when house prices go up, it's under inflationary conditions with rising interest rates. We don't have anywhere really in history that shows increasing in house prices like massively and having declining interest rates. Declining interest rates happen at the bottom of a market crash. They decline interest rates because they're trying to spur more loans. They're trying to reinflate the credit deleveraging. They want to leverage back the credit up. And when they start leveraging it up and we start getting inflation in the system, that's more money in the system. That is, by definition of inflation, is a leveraging up of credit. That money comes into the system, it is inflationary, and then interest rates go up because it has an impact on bonds. And people will sell their bonds when they have either real negative rates or interest rates go up and their bond prices go down, because when interest rates go up, it's going to force bond prices lower. So they rotate money out and go into other assets. That's basically the entire thesis of the channel right there. But looking at that, house prices going up, if they taper, I think you're going to see gold prices really start to move. They're going to see pressure on stocks to go down and bonds to go down. So that's kind of where my head is at. I think home prices will continue to go higher until the supply-demand imbalance is rectified. And it's going to take time, and house prices are going to become less affordable. That's my take on it. Will house increases slow down some? They very well could. They may not. They may not slow down even with increasing interest rate environment. They've lived in this declining interest rate environment for 40 years, so I think they've got it wrong on some of this stuff. So I'll end it there. Hopefully you guys got some value out of this on answering your questions. If you did, give me the thumbs up. Subscribe to the channel if you haven't already, and thank you for listening. This is Finding Value.